Does this change the dial for you in any way?
It doesn't. We were most preferred on oil, so it makes us quite happy, and our clients quite happy to see something like that. We had short put options in the market around $78 and now they are nicely trading back into the negative, which is of course a positive for us. We were in the $100 camp already. We thought like, yes, demand is coming off because there is a slowdown happening, and the U.S. most likely goes into recession, but it's exactly that. The OPEC, particularly Saudi Arabia, and it's really a Saudi Arabia deal, is protecting prices, can manipulate, if you will, the supply side, and it's a pretty strong statement. There's also a statement against shale gas or shale oil in the U.S. that under $70, that's when they become profitable, and that's a statement that we don't want to see prices there.
Adrian, on the one hand, an oil price increase for the Federal Reserve is, in effect, a bit of tightening going on, but on the other side, it's inflationary. So you're caught between a rock and a hard place.
True, but if you look at year-on-year data, it's still very disinflationary, because a year ago we were above $100. Yep. We had gas prices 70% higher than now. So we do think that the inflation itself from the commodity side will still roll over. Even on the capital goods side, what is the issue on inflation is still the employment side, the service side, and that's where we have very tight labor markets.
Adrian, surely there is some inflationary pressure from here, bearing in mind that the U.S. was already dipping into its emergency reserves before this.
Well, absolutely. I think they have eventually buy back some of these reserves. It will have an impact. But the way we calculate inflation, for good or for bad, it's a year-on-year assessment, and from this perspective, there's still a lot of disinflation pressure coming through. But it's true. The commodity price complex, we actually not just most preferred on oil, I mean most preferred on the whole commodity complex, because we also think that the China reopening will have some positive effect on commodity prices overall, despite the rest of the world probably goes into a slowdown, and as I said, the U.S. will end up in a recession.
Where do you see yields headed on the back of this, Adrian?
Look, we are most preferred on bonds. We do think it's really worth to lock in some of the duration. Now, I know that time deposits are very attractive, around 4.5% to up to 5% for a 12-month time deposit. But we really strongly recommend our clients now to lock in some of the duration, go 4 or 5 years into bonds, in particular high-quality bonds, as credit quality is really important, because the Fed is almost done with hiking. There's maybe one more hike coming in May, and then they will have to start to see the impact on the macroeconomic growth, particularly also what's happened over the last couple of weeks, and they will start to look into cuts eventually.
Adrian, okay, with, let's say, 2-year notes yielding, what, 4.1% or thereabouts, I mean, do you see them at that level this time next year? I mean, that's the point here. Or have people missed the boat?
Well, and we actually do think that they will trade lower. And so you're looking in really a nice yield. Now, if you take a little bit of credit risk, but really high quality, it's really worth. On the other hand, equities at this point really look challenged with macro slowdown, what's going on in the economy. The Fed's still not quite done. High interest rates probably stay a bit. We just saw the CFO survey coming from the Fed, and the message is clear. Uncertain about macro outlook, really difficult to get funding, and then return on investment just doesn't look that great on some of these projects. So CFOs are holding back on spending and capex, and it will affect earnings and it will affect growth overall.